Hello everyone, welcome back. My name is Arias, and today we're going to talk about what's going on with Latch as a company and as a stock. Everything from them still not having reported their Q2 results and missing their deadline to file the 10Q at the NASDAQ, to their Q1 results and a look at my full Latch model. I'll also decide whether or not I'm ready to cut my losses and move on from the company. Don't forget to like and subscribe if you enjoy this type of content, and leave any video suggestions and feedback in the comments below. And without further ado, let's get into it. First, let's talk about their last reported results from Q1, which were a pretty mixed bag. On the positive side, they reported having $335 million in cash and equivalents and marketable securities, which is over 2x their total market cap value, and the company has no debt. That just goes to show how priced for bankruptcy this company is, as investors are assigning a negative $150 million value to the business. They also reported revenue of $13.7 million, representing 106% year-over-year growth, with a total gross margin of 4.5%. That top line number is first made up by $9.1 million in hardware revenue, which grew at 80% year-over-year, but had a negative gross margin of 21%. The poor gross margin was negatively impacted by hardware shortages, and that should be expected to improve on its own going forward. Next was software revenue, making up just $3 million in sales, but growing 88% year-over-year and having a sweet gross margin of 89%. This is where a lot of the value of Latch will be derived in the future due to its extremely high gross margin. Finally, we have a new segment in services with $1.6 million in revenue at a negative 10% gross margin. This new segment is revenue from the installation and activation of their hardware devices from the building owners that they are selling to. I wouldn't expect this to become a supremely valuable part of Latch's future, and they will likely just run this at a break-even gross margin to help business owners get these installed and running so they can start collecting the high-margin software revenue. They also reported booked ARR for the quarter of $7.9 million, growth of 137% year-over-year. This may be the way that Latch comes to be valued in the future as a multiple of their ARR, like many SaaS companies, and thus this is a very important and interesting metric to keep track of. Finally, they had astronomically high operating expenses of $51 million in the first quarter, roughly split equally between research and development, sales and marketing, and general administrative. The $51 million number in Q1 translates to a massive per year run rate of over $200 million in expensive. That has to come down, and it will, as you will see later in the video. Now let's talk about the level of credibility they have built with their guidances from their SPAC presentation versus their actual reported revenue and guidances that they have set forth since. In short, it's been a whole lot of disappointment. In their SPAC presentation, they guided for $49 million in revenue in 2021, and that came in about 15% short of that at $41 million. Not a huge disappointment, but definitely significant. Then in 2022, the SPAC presentation said that they were expecting to deliver $138 million in hardware revenue and $35 million in software revenue. This would have been breakout growth over the prior year, and they would have just finally started throwing out some real gross margin. Then in Q1, they guided for just $60 to $80 million in hardware revenue, down from $138, and just $14 to $15 million in software revenue, down from $35 million. Since then, they've even scrapped those guidances with the restructuring they're going through, and we'll talk about that later. All of this is pretty disappointing in my opinion, and shows that the rollout has slowed significantly. However, management has said that supply chain difficulties have been a key factor here because of delayed building finishes, and this should be taken into account as well. I'll be watching very closely, especially for what they give as guidances for the rest of the year and for the next year, 2023. Now let's talk about some of the changes. First, they have said that they are moving towards selling more second and third party devices. These devices will have Latch software and will be either completely manufactured by someone else or will have everything but the main key module, which Latch will contribute, manufactured by someone else. This will allow Latch to sell more high-margin software revenue and take less losses in their hardware business. This is definitely a positive short-term business move. However, I think there's definitely some good to be had by owning both the software and building the hardware because you can more closely control the customer experience. This is exemplified in Apple, where many of Latch's executives draw their roots, and I just hope they keep this in mind and make sure to put the user experience first. Another big change that they are making that I think is unequivocally positive is that they are moving away from bookings as a metric for the sales team and for reporting to investors. In its place, they are going to incentivize real sales, especially of hardware revenue and ARR. I love this move as bookings were very esoteric and could vary wildly in delivery time, as we've seen, and in profitability, as $1 of hardware revenue is not the same as $1 of software revenue. Not only are they moving away from bookings, which I dislike as a metric, but they are moving towards software and ARR, which are both key metrics that I like for the business. Another huge change that I feel very mixed about is they have cut a huge portion of their workforce. In 2 rounds, they've cut over 50% of their workforce, totaling over 245 employees, which is expected to cost $8 million in restructuring charges. One of these rounds was in May, where they let go 28% of their employees, and one in August, where they let go 37%. First and foremost, my heart goes out to all of those affected. I hope Latch takes care of you as much as they can, and I hope you find somewhere something better. From a purely business point of view, this has good and bad parts. The good thing is, Latch expects this to save $90 million a year once these changes are complete, meaning they will have operating expenses of approximately $65 to $75 million. The negative is they have to cut their guidance for the year with a reduced workforce. And even worse is how we have no idea how much or what effect they expect this to have on the next few years, and there's no specific time where we can expect to hear that. Overall, it will help to keep Latch alive, as we will see in a few slides from now, but I will need to see these burn metrics hit, as not burning cash has become a key to their survival rather than growing their way out of the losses. Let's now look at two models and try to figure out if Latch will get to profitability or if they will go bankrupt first. Of course, these aren't financial advice and are just to illustrate a point. The first model I would consider to be more conservative, but is not the most bearish one I could dream up. Starting with revenue in 2022, I modeled that they would fall far short of the low range of their guidance of $75 to $100 million in 2022 revenue and come in at $50 million. And then I modeled the relatively tame growth tapering off from 35% from 22 to 23 to 20% from 2030 to 2031. This was a company that was projecting to grow above 50% for years to come and hit $800 million in revenue in 2025. So to end 21 at just $370 million is pretty conservative in my opinion. Next line, I estimate how much of their total revenue will be hardware revenue and consider the rest to be software revenue. I projected throughout the model to have hardware revenue decline from over 80% last year to 40% in 2031. Over time, the ratio of software revenue should increase because hardware revenue is a one-time install, whereas software is a long-term annual recurring revenue. This is a very important transition because of how high margin software revenue is. From this ratio, I derive how much revenue there is for each software and hardware, and then estimate the gross margin. I have hardware gross margin getting to break even quickly as supply chain issues wane, and then turning slightly positive. And I estimate software's gross margin to decline from the current levels of around 90% to 80% by 2025, and then stabilizing around there, because this is what they had expected in their SPAC presentation. I don't understand the reason for this projected decline, and I would be interested in asking if I ever got the chance. From these estimations, we get the total gross profit. I then deducted the total operating expenses. I projected $170 million in expenses for 2022 because of how astronomically high their expenses were in Q1 and the fact that they did not start cutting costs until May and did not announce all the changes until August, meaning they will still incur significant costs throughout the year, and they will still incur those restructuring costs this year. I have this declining to $75 million next year, the high end of the range that they gave in one of their press releases, but then growing at a stable 10% rate out to 2031. After we deduct the expenses, we get to the bottom line, of course. This has them taking $160 million in losses this year, but dropping that down to just $50 million next year, and then steadily declining until they finally turn profitable in 2029, and then end 2031 throwing off $55 million in cash. Then we finally get to see what effect this has on their cash position, and while they run their cash all the way down from $380 million to $30 million, they don't go bankrupt. They in fact build that cash pile back up to $117 million, which isn't too bad for barely turning profitable. But if we do a little sensitivity testing, this model is highly levered to revenue growth, and if we cut the growth by just 5% in a key year, we could see the cash balance going negative. While these would not be good results for Latch, and we cannot rule out bankruptcy as a potential outcome, this shows that they can indeed make it to profitability without truly explosive growth investors are hoping for. Now let's move on to a more bullish case, although this is not the most bullish I could be, on Latch, as you will see on the next slide. Some of the things I've changed are increased growth rates, with Latch hitting $850 million in 2031 revenue, a slight increase in the speed of shift to software, and I increased the amount of operating expenses due to the increased growth. Other than that, I've left the previous inputs and structure the same, and this results in Latch approximately breaking even in 2025, and even turning $20 million profitable in 2026. They finished 2031 with nearly $1 billion in cash, throwing off $250 million in cash per year. That would obviously be a pretty positive outcome for the company, with a market cap of less than $150 million currently, or 0.6 price-to-earnings ratio, 10 years out, for a company at that time that would still be growing nicely. But I still don't think this is as bullish as I get with Latch. The company has estimated their total addressable market in the US and Europe to be $144 billion annually. Of course, this is one of the massive total addressable market size numbers that companies throw out in investor presentations. But even if you thought in reality it was just 1/10 the size they estimated, that would still leave Latch with these numbers at just 5% penetrated into the market in that bull case. On the next slide, while staying conservative, let's dive more into Latch's potential future valuation. Let's move on to talking about, in simple terms, their valuation, or how they could be valued way out in the future. These examples are just that, examples. just to illustrate what Latch could be and frame how we're thinking about their current valuation. Latch was expecting in 2025 to hit $412 million in net software revenue. Now, with the recent headwinds forced by the market, and to be more conservative, let's say it takes them until 2030 to hit the $400 million in software revenue, which is about 5 years later than they were initially projecting that they would hit this mark in their SPAC presentation. It would still be a pretty aggressive growth rate of 52% every year, but that should be no problem for this company with as much room to grow as they have. Let's assume, for the sake of simplicity, that their hardware business can fund all of their operating expenses and that the gross margin of the software business drops down to the bottom line. In their SPAC presentation, they expect their software revenue to have an 80% gross margin, and let's assume that happens despite their current 90% gross margin. At a conservative 25 PE ratio, that would yield an $8 billion company. That's roughly a 53x from today, or roughly a 64% CAGR in the next 8 years or so. And all of that is if they hit their 2025 target in 2030. What if we were to cut that target in half and delay it 2 more years with the same other assumptions that would still have the company worth $4 billion, or roughly a 26x from here in 10 years? Now remember, that's 1/4 of their target 7 years late. Now just for a moment, let's pretend they were able to hit those crazy SPAC targets when they originally said they would. With the same surrounding assumptions as above, the company would be worth $8 billion in 2025, which would still be a 53x on your money from here, or an absolutely ridiculous 276% CAGR. Now, while I don't expect any of these discrete cases to happen, I hope I can illustrate the case for upside if they can execute and succeed. There is still a very real chance of bankruptcy, especially if these accounting irregularities really run deep, but I've shown on the last couple slides that they can definitely get to profitability, even with so-so growth and execution. That is why I'm leaning towards sticking around, despite the content of the next 2 slides as bad as it is. Now let's get into the real meat of the video. What's going on with their reporting? There were 2 press releases, the first of which was on August 11th, and they said that they had failed to deliver their 10Q to the NASDAQ by the due date. Now they have to submit a plan by October 10th to get back into compliance, and if accepted, they will have until February 6th of 2023 to execute that plan. Of course, there are no guarantees that their plan will be accepted, and if not, their stock may have to be delisted, which would obviously be very negative for their stock price. At this point, investors knew something was up and it wasn't good, we just didn't know what. We would find out more details on August 19th when they said that their 2021 results and their Q1 2022 results cannot be relied upon because of errors in the recognition of sales of hardware devices. These errors were made, according to the company, due to unreported sales agreements from sales activity that was inconsistent with the company's internal controls and procedures. It sounds to me like some salespeople got sloppy with some of their hardware sales agreements and they finally caught it. Of course, this is pure speculation. They said that the assessment of the damage is complete, but there would definitely be at least some weakness in their restated finances. With the investigation ongoing, they said it could affect more quarters than just the ones originally stated. The good news from this is that hardware, due to its negative gross margin, makes up a small part of the company's value compared to the value that the software revenue brings. I'd also like to point out that Garth Mitchell, their former CFO, left recently, and that may have had something to do with this. I of course have no reason to believe this except that the timing is very odd. Going forward, I'll have to determine if I want to be involved with a company that has such poor standards for ensuring the right thing is being done. But what I also think is important with Latch is to get back to the basics and remind ourselves what they do as a business. Latch provides smart locks that they estimate allow landlords to increase rent by $200 to $500 per unit per year and reduce expenses to landlords by $100 to $300 per unit per year. Providing value is the whole point of business, and because they're providing this value, they can earn a cut in return from these landlords. And while many may look at the fact that they have to install the hardware as a negative for the business, the fact that the hardware is physically installed into doors locks customers into the long-term software contracts that are so lucrative. Landlords would have to go through decent effort to have these locks taken out and replaced if they wanted to rid themselves of Latch, and this provides certainty and security for Latch's business. Additionally, users have the option of using their phone and Latch's app to unlock the door. The hardware install and the usage of the app gives them a stepping stone to launch into providing other high-value services, all centered around making spaces a better place to live. These services could include internet, insurance, in-home services, rent payments, or integrating smart home devices. At the end of the day, Latch has a massive market opportunity to grow both the number of units which Latch products are installed on and revenue per unit. Management estimated a total addressable market of 47 million rental homes in the US alone, a $54 billion per year market, and 93 million more homes in Europe. Even with the built-in optimism that comes with the territory of an investor presentation, the opportunity is massive. The size of this potential opportunity and the massive discount is what's keeping my money in Latch for the time being, despite the poor execution and misstatement of their financials. Finally, for my conclusions. Latch's services are very valuable to the customers that they serve, and they have done a nice job locking them into long-term contracts. Their valuation has fallen like a rock despite the massive market opportunity that is still very much ahead of them. While I don't think the restatement of their hardware revenue should sway my opinion of the company too greatly, I will have to reevaluate if I want to own the company after this situation is resolved. I think it's going to be proven for investors to endeavor to stay calm in the eye of the storm and make data-driven decisions to focus on the business and try as much as possible to set emotions aside, as hard as it is to do as you're watching your hard-earned money go up in flames. For now, I've decided to hold on to all of my Latch, but I will resume buying aggressively if the current situation is resolved, they report earnings, and give more guidance on where they see the company headed. Latch currently makes up a little more than 1% of my portfolio, or 4.3% ex-Tesla, at a somewhat painful $7 cost basis. Thanks for watching. What do you think of Latch? Do you have any critiques of my model? And where do you see them in 10 years? Most importantly, what do you think of their recent drama? Let me know in the comments below. Thanks again for watching and have a great rest of your day.